Welcome to Real Estate Syndicator Live. I am your host, Mauricio Rauld. With more and more people thinking about starting real estate funds, I figured we should do an episode on the pros and cons of doing a fund versus a project-specific syndication, not only from the syndicator side, but also from the investor side. We also took some amazing questions from our community involving customizable funds, fund of funds, and becoming an accredited investor by taking and registering your Series 65 exam. This week on Real Estate Syndicator Live, I wanted to talk about the pros and cons today of funds because I've been noticing, we do a lot of funds, right? So I've been noticing that there's been quite a bit of pushback lately. And so let's go through sort of what the pros and cons are, right? So the first pro of a fund, I think, is probably the stress. Let's put it this way: it's probably the lack of stress involved in raising capital. Let's face it, that's probably the number one reason people want to do a fund. A project-specific deal, as you guys know, you get in a contract first, you know exactly how much you're going to raise, and then you have to go find the money for that particular deal, and you are time constrained. You've got 30, 60, 90 days to close. It's stressful, especially if you're a first-time syndicator. Getting across that finish line, those of you who've done this before, you know that's super stressful. So it's really nice to do a fund where you actually raise all the money first, have it sitting in your bank account, and then you go look for property so that by the time you find a property, you've got the money in the bank. You don't have to stress about that. So I think that's probably one of the biggest pros that I see, especially for people who have never done a fund before, and it's really appealing for them to do that. Another pro is the competitive advantage you have over your competitors, because when you're up against 2 or 3 or 4, and it used to be 10 or 20 and 30, but these days a little bit less. But when you're up against competitors for the same property, the ability for you to come in and say, look, I don't have to raise the money. Here's my bank account. I've already got the money in the bank. You are assured that I am going to close if I want to. I don't have to rely on going out to the public and get capital raised like these other people that are competing. And so there's an assurance on the part of the buyer. You take away that risk for the seller that you have the ability to close. It also provides you an incentive to pay all cash. You have the option now to go in there and pay cash on a particular deal and then maybe get debt later on, which again puts you in a great advantage because you're likely going to get either a discount on the price, or again, you're going to be able to close much faster, again, putting you in a much better position than if you were competing with everybody else. And then obviously, especially if you're buying smaller properties like single family homes or maybe smaller commercial, you're able to buy in bulk. If you've got $2, $3, $4, $10 million in the bank, you might be able to come in and buy a portfolio of properties and get a discount obviously there. So that's kind of the advantage of having a fund when you're able to have all the money in the bank, as opposed to having to go raise the money after that. You obviously don't have to prepare offering documents every single time, which I know is kind of a logistical nightmare, not only for you guys, but the investors. So with the fund, obviously we create one set of documents at the beginning. It takes a little bit more time. It's a little bit more complicated, but then you send that out to your investors and you don't have to keep going back to the well every time. And if people are if people really trust you, then they actually don't even want to look at documents every time. They just want to send you money and say, just go, Mauricio, go do your thing. So not having to prepare documents every time is definitely a big pro. The other pro these days, and actually this is the same thing that happened back during COVID times, there's people starting to put together vulture funds, or let's call them a more PC term, an opportunity fund, where with all the distress that's coming in, you guys have heard about all the distress, all the cash calls, all the foreclosures, people are losing. A lot of my clients are reviewing distressed properties, and if there's a chance for them to put money in there and take it over and turn it around, they will. But having a fund helps you do that. There's going to be, I think, and probably everybody in this room agrees that there's going to be an incentive, or an opportunity, I should say. There's going to be an opportunity to pick up some properties at a discount, but you have to act fast, right? You can't just sit on it for 60, 90 days. You're going to have to be like, hey, I like it. If you have the money in the bank, it's going to be much quicker and easier for you to go pick up these funds. If you have an opportunity fund, let's call it an opportunity fund instead of calling it a vulture fund. But you guys get the idea. Having that puts you also in an advantage to pick up some of these properties, cents on the dollar. The final benefit, and by the way, these are all benefits that, if you haven't noticed, are benefits for the sponsors. I'm going to talk about the benefits to the investors in a second. The last benefit for the sponsor, which a lot of people forget, is that you have much more options when it comes to the exemptions, right? Usually we look at 506B, 506C. Reg A starts to look really attractive when you're doing a fund, or maybe even Reg CF, because the knock on a Reg A, which by the way allows you to advertise and it allows you to take non-accrediteds, which is great. The knock on it, of course, is that you've got to wait 6 to 12 months to 9 months, let's say, to get it approved by the SEC. And so if you've got a project specific deal and you have to close within 60, 90 days, that's just not realistic for you to do that. It's not really an option. But if you're going to do a fund, well, now Reg A does look appealing. And so you know, again, you're under no pressure to close. That's one of the benefits of putting a fund. And so Reg A starts to become really appealing. Reg CF is another one that can become appealing. So just expand your horizon a little bit in terms of the exemptions that we can rely on. Then, of course, there are benefits for the investors themselves. And I came up with three main ones. And if you guys can think of another one or different ones, let me know or start thinking about that. But number one, obviously, is diversification, right? So on a project specific deal, you have the profit and loss of one particular asset class. And that asset class does great. But if it doesn't do great, all of your eggs are in one basket, so to speak. And with a fund, typically you're buying multiple assets, 3, 4, 5 multifamilies or self-storage, 5, 6, 7, mobile home parks, even more. So it just gives the investor diversification that if something were to happen to one of the assets, you've got 5 or 6 or 7 more, which helps with the risk. And again, just kind of diversify. So that's really a big selling point that I usually see syndicators make when they're doing funds to their investors, is this idea of diversification, getting a piece of more markets, more asset classes, all that fun stuff. Another benefit is they don't have to review a bunch of docs, just like you don't have to prepare a bunch of docs. They don't have to review a bunch of docs. They just have to do their due diligence once. They do the due diligence on the sponsor. They like what they do. They look at their track record. Great. They invest the money. They don't have to come back every time to look at new docs or anything when they've got more money. If they have more money, they can, depending if the fund is still open, they have the opportunity to add to their investment, but they don't have to review another set of, 150, 200 pages of docs, which nobody likes. And I acknowledge that. And as I mentioned earlier a little bit, the third one I think is just the due diligence is once, instead of having to do due diligence on every single deal. They come in and look at the property and look at the numbers and look at the market and all that stuff. They just do that due diligence once. So a lot of investors like that. The cons, though, are starting to mount more and more these days. I think the first con has always been there, and that is that it's much, much harder to raise money for a fund than it is to raise money for a project-specific deal. With a project-specific deal, the investor can actually see what you're buying. They can see the pretty pictures. They know exactly where the property is located, what type of property it is, what kind of lending product it is. They can see the pretty pictures. They can see your pro forma. They can agree or disagree with your assumptions. You're going to give them all of the assumptions in your deal. They can say, dude, you're crazy. There's no way you're going to get 4% rent hikes. I think you're going to get 2% or 0%. There's all these assumptions that I can sort of re-underwrite if I'm an investor, which goes away with a fund. With a fund, obviously, I'm betting on you. I'm betting on the jockey, and I'm just trusting you with my money, and I'm trusting that you're going to go find the proper asset within the parameters that you've already given me. But it really becomes a trust thing. And so a lot of investors, they just like to see the property themselves. And so it's just harder. I would never recommend a brand new syndicator who's never syndicated before to start a fund. I just think it's really, really difficult unless you just have a huge audience already. I mean, that's probably the only time I've seen my clients who have, big followings on social media. Those guys can, obviously put together a webinar and they'll have, hundreds, if not thousands of people attend, and maybe they can raise money in a fund right from the get-go. But typically it's much, much harder. And that's probably the number one con of a fund, is just, it is much harder. As much as it's great for a syndicator, and if everybody could do it, maybe they should, but it's just not everybody can pull that off. So that's probably the biggest con of doing a fund. The other one, which is really what prompted me to do this spiel or presentation, is that investors are starting to push back more and more in funds. I think investors liked the idea of having a project specific deal, probably for the reasons I just enumerated earlier, because they like to see what exactly they're investing. They want to be able to challenge your assumptions or know exactly what the property looks like in the market and everything we just discussed. And they got used to that. And over the last 12 to 18 months, sponsors have been, I don't want to say forcing them to go into funds, but they've been coming out with more and more funds. And a lot of our clients, especially our seasoned syndicator clients who've been doing this for many, many years, who used to do project specific deals, then went the fund route over the last 12 to 18 months, they're actually starting to come back to project specific deals. And it's not because they want to necessarily, but I think it's the market that's demanding that they go back to project specific, because they don't want to be investing in just, I don't know what you're going to go invest in. You just go pick something. They actually want to see what you're investing in and then want to put all their eggs in that particular deal. So that's just a market reality. It is what it is. As prudent business people which is obviously this is a business. You listen to the market, and if the market's starting to go a particular direction, then that's where it goes. And so that's probably the biggest con these days, is I think there's just being pushback. So if you can only imagine, if you're just starting out, you've got the issue of it's being already harder to raise money in a fund. Now, on top of that, the market is pushing back and saying, no, we'd rather still see project-specific deals versus a generic fund, which in theory is better for the syndicator, but maybe not as good as beneficial to the sponsor, to the investors. The other con is that it is more complicated to put together a fund. There's a lot of things that go into structuring the fund, not necessarily structuring from a mechanical standpoint, but what's the word I'm looking for? The ways you structure it inside. So for example, I'll give you a couple examples. Do you want to raise all the money up front, for example, is a good question. You don't have to think about that on a project specific, because I got to raise 2.3 million. That's what it costs to buy the thing and to fix it up. With a fund, it's like, well, I'm trying to raise 5, 10, 25, $50 million. Then the question becomes, do I take all the money up front where it's sitting in my bank account earning nothing? Well, maybe 5% now, or do I take it in steps? Like, there's all these questions. Withdrawals, do investors come in and out of the fund, or are they all forced to stay in the fund for the entire duration of the fund? In a project specific, it is what it is. It's a 5-year deal or a 5 to 7 year projected term, and then people come in and people come out. With a fund, a lot of times funds are 5, 10, 15 years. And so the question becomes, well, how does the investor exit, right? Because the investors want to come out. And then I think I lost my notes here a second. My last point here. Oh, one of the other cons, which is actually a pro and a con, is that you have no pressure to close. And because of that, it tends to when you've got to close and we got to raise a bunch of money within 30, 60 days, rubber meets the road, you go do it. When there's no pressure and you can take 3 months or 6 months, a lot of people, it does take them 3 months or 6 months because they have that pressure to close isn't there. And so I've seen a lot of people start funds that really they never finish. They get all excited about the fund. They start raising capital, but it starts to drag on to like 3, 6, 9 months. And at the end, they just abandon it, because what is a pro, which is less stressful, it's also a con. So anyway, those are kind of my pros and cons. If you guys have any additional ones that you think you missed, I'd love for you guys to drop it down in the comments or the chat over here, and maybe we can go through it and we can discuss it amongst ourselves. But with that, I wanted to, how long was that? A 15-minute rant. It's probably longer than I wanted to go. But if you guys got specific questions on funds, let's start with those. And then after that, we'll move on to anything else. So let me look at the chat first, and then I'll call on you, and then you can just unmute. Let's go with James. Is that the James K? James, you here?
Yeah, I'm here.
Go ahead. Do you want to ask your question?
Yeah. I heard under 506C, if it's an evergreen blind fund, we're only able to take up to 99 investors. Is that true?
No. Next question. No. The 99 investor limitation is actually 100. The number is actually 100, but that has to do with avoiding having to register under the Investment Companies Act of 1940. And the only time that comes into play is if you are in the business of investing in securities, right? So if you're in the business of investing in securities, then that triggers a whole bunch of other regulatory issues. And one of them is making sure I am not an investment company. And the easiest way for me to get around that is this, what's called a 3C1 exemption, which means I don't have to have, as long as I have less than 100 investors and the GPs count as investors. So if there's 6 people in the GP, then I can only take 94 passive investors. And it also gets tricky is how to count them. It's really beneficial owner. So you got to be super careful about the counting. So if you ever get close to that 99 or 100, you want to be consulting with your attorney. But it's not, if you're in the business of doing a fund that invests in real estate, meaning your own deals, like most of us are, then that does not come into play. In our world, really, since this is a real estate, we're doing real estate syndication, at least that's what the vast majority, 99% of our clients do is real estate. The only time that would come into play is if you're doing what's called a fund of funds. Because if you're doing a fund of funds, now when you think about it, you're investing in somebody else's deal, you're investing in somebody else's shares, technically their membership units or limited partnership units in the other deal. And now that means I'm investing in a security. And at that point, that's where it triggers not only Investment Companies Act, but the brokerage stuff. You're an investment advisor. We got to worry about investment advisory rules at the federal level, at the state level. It opens up a whole new can of worms, but only when you are advising your fund as to the purchase of securities. If you're advising them as to the purchase of real estate, you don't need any special license to go buy real estate. Great question, though. Irish Kevin in the house. Hold on a second. Hold on. Yep, go ahead. I see the word fund. Go ahead, Irish Kevin. I haven't seen you in a while. How's it going, buddy? You want to unmute, or do you want me to ask
Yeah,
it?
how you doing there, Mauricio? Thanks for the invite and the short little presentation here.
Yeah, appreciate you.
Yeah, my question to you was, I had it in the chat. You can't advertise a Reg A, or you can.
The question in the chat is, why are you able to advertise a Reg A to the public when you can't advertise a Reg 506B? A Reg A CF fund requires use of a portal. Yeah, so these are all different exemptions, right? If you want to go back to basics, when you're selling securities, remember there's three things. You have to either register with the SEC or find an exemption, or it's illegal. It's one of those three. Register, find an exemption, it's illegal. We don't want to register full-blown registration because that's an IPO. That's going public. That's not what we're in the business of. We don't have, forget about 6 to 9 months. You don't have 12 to 24 months and 7 figures to go public with your company. So we're not going to register. We obviously don't want to do something illegal or no compliant. So we're always looking for the exemption. And so these are just different exemptions, and each exemption has a different rule. Like the ones we usually use are 506B. That's the vast majority. So no advertising, but you can take non-accredited, it's 35. Then there's 506C, which does allow us to take accredited, but it limits us to accredited investors only, and there's a verification. But there are not 1,000 other exemptions, but probably another 4 or 5 that you legitimately could look into. One of them is Reg A. And Reg A is what we call a mini IPO because it's a mini registration, meaning we don't do a full-blown registration, but we do have to get approval from the SEC. This is why it takes 6 to 9 months, because after we prepare all the documentation, the PPM and the what's called the offering statement, we then have to submit that to the SEC, and the SEC has to bless it. So they're going to review it, and of course they're going to take their pretty time. We're talking now with government attorneys, right? Attorneys at the SEC office. They're going to come back and say, hey, we reviewed your PPM. You need to change this. We don't like this. You need to do that. You need to do. We looked at your website. Your website's not compliant. We need to and they're just going to not tear it apart, but they're going to give you feedback. So then you go back and you do another draft, and then you submit it again to the SEC, and you probably do that 2 or 3 times until the SEC says, okay, great. I like the way you've done it. Now we've approved it. And once it's approved, so you do have to get approved, then you're able to go advertise just like you can a 506C, but you're also then allowed to take non-accredited investors, and there's no limitation other than 500, just because 500, you've got to go public if you've got 500 non-accredited, or if you have 2,000 in general, you've got to go public. But other than that, you don't have this 35 limitation. So you could take 499 non-accredited. The limitation has to do with how much you can take from non-accredited. So you can only take 10% of their net worth or income, whichever is highest. So that's the limitation, which is why a lot of times you see Reg A's with $5,000 investments or $10,000 investments, because these are people that make, if you make $60,000 and don't have much net worth, and the most you can invest is $6,000, 10%. But that's just the nature of that exemption. With a Reg CF, that's another exemption, right? And Reg CF is getting a little bit more popular now because they raised the limits. It used to be $1 million raise in the last 12 months. They recently bumped that up, I think during COVID, up to $5 million. But you've got to your point, you've got to use a portal, right? You can't advertise that on your website like you can on a 506C. You have to use a broker-dealer website or a SEC registered portal. And there's very limited things you can do to point to the portal. And then all the advertising happens at the portal stage. And of course, there's portal fees, and there's a lot of fees involved. But again, these are just different exemptions. And so that's what a good securities attorney would do, is go through your specific facts and say, hey, these are all your options. What exactly do you want to do? Do you want to take accredited? Do you want to take non-accredited? Do you want to advertise? How much? All these questions that we ask, and then we decide what's the best exemption. My point was simply that if you're doing a project-specific deal and you have to close within 60 days, you don't have time to go spend 6 to 9 months and ask for permission from the SEC. It's just not. It's not even an option, right? Reg CF maybe, although it does take a little bit more time. It doesn't take as long as a Reg A. So anyway, the point is, it opens up your world to a bunch of different exemptions, and you just need to be aware that you do have more options when you're having a fund. Great question, though, Trevor. I'm sorry, great question, Kevin.
Hey, thanks for doing this. Quick thought on something we've been researching is kind of a hybrid model, and maybe you could elaborate on this because we're still trying to learn, but would be we've seen a platform called Avestor. Not sure if you've heard of it. It's like a custom fund where you can actually still raise project specific, but these projects, these assets all go into one custom fund. Not sure how they're setting that up, but something we're intrigued with because we can still come to our clients that are investors that want to invest specifically in a certain project, but those are all treated differently in different asset classes inside this custom fund. How does that work?
Yeah, so I mean, a customizable fund works pretty well in certain circumstances. So for example, we've done a couple of these customizable funds. I have talked to an investor. We may start working with them as well and help them do some of theirs. And it's great because you create let me explain it. Maybe a customizable fund. So a customizable fund, hopefully it's customizable for both the sponsor and for the clients. But generally speaking, what you want to do is you create sort of not a generic, but here's the fund documents at the high level, which says, hey, I'm raising $10 million to go buy multifamily, or maybe it's sometimes different asset classes, some multifamily, some self-storage, some mobile home parks, whatever. But before you actually invest in a particular deal, I'm going to show you specifically about a particular asset. So let's say I create the fund, great, all the offering documents for the fund, and then you go buy your first property. And you say, well, the first property in the fund is this mobile home park. So if you want to come invest, you can participate just in this asset class. Even though you're part of the fund, the umbrella fund, you're only going to be responsible for the profit and loss and the tax depreciation of that mobile home park, number one. Right. And so we structure it in such a way that we do it actually through classes. They do it through a little bit more complicated thing, but either way, it doesn't matter. Even though I'm part of the fund, I'm only going to benefit from the profit and loss of that particular asset. Now, every time you do that, you need to provide, remember, every time you sell a security, you have to provide them with all the disclosure documents. So you still have to have, in my opinion, you want to have an attorney be reviewing all of those assets as they come in so that the attorney can determine what specific risk disclosures on that particular asset class, right? Because you've given the broad disclosures on your big PPM, right? Hey, mobile home parks, for example, give that one. So there's going to be a bunch of generic disclosures to what the risks are in mobile home parks, how those work. But then when you actually acquire the first mobile home park, there's going to be specific risks associated with that mobile home park, like, the market where it's located, what's the vacancy looking like, what's the loan product, like all those little things, and who knows what else. Each one's going to be unique. You just want to make sure you're giving your investors sort of an addendum to the main PPM. You're going to do an attachment or an addendum. It might be short that just says, hey, here are the risks of this particular deal. Here's the P&L of this particular deal. Here's the fees we're going to charge for this particular deal. You kind of give them all those disclosures. And then if the second property, now it's a self-storage deal or maybe another mobile home park, great. Now investors come in only for that particular deal, right? And only have the profit and loss of those. And the idea is, if it's done the best way, I would think, is that you have multiple assets, right? You're in contract to 3 or 4 different asset classes, and that gives you the opportunity for the investor to come in and say, hey, of these 4, I like this one. So I'd like to invest specifically in asset number 3. And we're like, great, here are the disclosures specific to this one. Again, you're signing the main PPM. Here are the disclosures specific to that asset number 3, and you will be only getting the profit, losses, and depreciation on asset number 3. And so it's an attractive model. That's why we've been doing more and more of these as people come in, because it gives a little bit of flexibility on the investor side, because they get to pick which deal they are instead of doing the main one. And then for the syndicator, it potentially be cool because, we work with them in terms of structuring it however they want to structure it. Like every customizable fund is different. So we give them the flexibility of, well, how do you want to structure this? What are the terms of the main PPM? But it's an interesting model, and more people are doing that. And I've kind of embraced the model. I think my only knock maybe on not specific to Avestor, but of all the industry, is that it's everybody wants to think that we found the magic potion where it's cheaper, it's quicker, it's faster. It's like, no. It does add a little bit of complexity to it, right? So it doesn't necessarily make it easier and simpler. It does have its complexities, but it's a pretty attractive once you appreciate that it's a little bit more complicated, a little bit more time consuming, maybe even a little bit more expensive. Well, probably in the long run, it won't be more expensive, but there's a little bit more upfront cost. The flexibility is attractive. I mean, especially if you've got investors who don't want to invest. Now, again, you got to be careful though. One of the big risks of that, and that's something you would disclose, on the first time, is that even though you are participating in only the profit and loss of any particular asset, you are part of the fund with everybody else. So if something were to happen to asset number 7 that you have no involvement in, and there's a lawsuit against the owner, or there's something that goes wrong over there, and they're going to sue the owner's the fund, and you're a member of that fund. So you could potentially get caught in if something were to, let's say property number 7 burnt down, or there was some catastrophe and they thought the manager was responsible. Well, they would sue the fund and they would sue the manager. And now you're a part of that fund. You're not going to be sued personally, but now resources from the fund of your cash is going to be used to go defend, you know, that asset number 7, right? Especially if there's money that's lost. If the investors decide to sue the sponsors, they're going to sue the fund, and you get caught into that, not to say drama, but you get caught into that litigation because you're a member of a company that got sued. And that might slow down distributions. They may have to use some of your capital to defend that suit. So there's sort of this cross collateral risk because, again, everyone's part of one fund. The fund happens to have 10 different assets, and you may only be participating in the profit and loss of those assets, but everybody is a member of that one fund. The benefit of that is everybody gets 1K1, and there's a lot of benefits to it, but there's also some risk, which is you're all together. There might be 100 investors in that one fund. And if something happens to a property that you're not getting the profit and losses, it doesn't matter. We're not segregating all of the liability like that. We're all part of the fund. So there are some limitations to it, but there's also some attractive natures to it. So I like it.
So a follow-up question, Mauricio. Great explanation about the liability. This is Madhvi, by the way.
Yeah, I was like, got so many people here today.
I know, but just a follow-up question. So I'm a fund of fund manager. So I bring investments, and I'm on the Investor platform as well. So it's not particularly assets. The assets are with the sponsors directly. I'm a fund of fund bringing that. So essentially, I'm a bigger LP, writing that LP check to that from my fund, from my investors to that particular investment. So that way, it's a separation. So is the liability still that high because I'm still like a LP, a big LP to those assets, right? So if they get individually sued because they are in their LLC and whatever their manager LLC, the PPM that they return, their PPM is attached to my fund because it's a fund of fund. And another aspect of it is that how different is it if it was a blind pool fund and I was doing exactly the same? How different is the liability from that perspective?
So a fund of funds is just a structure. I would encourage you to think of a fund of funds different than a customizable fund, but you can combine those two. So some people have combined that where you have a customizable fund that not only invests in real estate that you're buying, like in my example, mobile home parks or whatever, self-storage, but they're also investing in other people's deals. So you can have a customizable fund that is also a fund of funds, or you can have a customizable fund that's just a blind fund, or you could have a customizable, which I think is more common, where it's a mixture, where it's a blend, it's a hybrid, where it's a customizable fund and they're investing in both their own assets, right, the mobile home park, and they're also investing in other people's deals. Now, when you do the fund of funds, you do, again, open up all the other regulations, right? Investment Companies Act. You are an investment advisor to your fund, so you've got to make sure that you're complying with federal and state investment advisory rules, and that usually is a state issue because I'm guessing it's less, maybe not, but I'm guessing you're raising less than 150 million. If it's less than 150 million, you can't even register at the federal level, so you're looking at that particular state. So what state do you live in? And then we want to look at the state laws where you live and find out what the exemption is to having to register as an investment advisor. So there's a lot of compliance stuff going in there. But from a liability standpoint, if you're just raising capital and then investing in somebody else's deal, right? And it's not a customizable fund. That's why I wanted to just differentiate between a customizable fund and a fund of funds, because they could be combined, but they're also going to be separate. But if you're doing a fund of funds and you're investing in somebody else's deal, then obviously your only exposure is going to be if something happens to that deal. You're just an LP, a big check LP, but you're just an LP in that particular syndication. And if that syndication goes south, that's going to be your risk. If it's a customizable fund, the question is going to be, if you're investing in the customizable fund as a whole, then you have the same risks that I described earlier, because if something were to happen to property number 9, the whole fund is at risk and you're an LP in that fund. But I know that there's a way to structure it, and some people have gone creative, which is great, where you only invest in that particular property alongside the fund. So you're not really a part of all the other ones, but it gets complicated, but there's definitely different ways to structure it. But I'm specifically just discussing the customizable fund. But like I said, you can have all kinds of variations of what that looks like.
Yeah, totally makes sense. Thank you so much.
Yeah, of course. Thank you.
The fund of fund just for investing into the, so I don't have any physical assets.
Yeah.
It's just
Perfect.
customizable fund of funds. So I just bring different assets, different investments, and just participate as an LP.
Perfect. I'm seeing some Nico, is this lawsuit for failure to perform due diligence in the selection and oversight of sub-advisors or outside funds? Oh, is this a con of Nico, is this a con of a fund?
Yeah, that's one of the things that we've been seeing over the last couple of years, as far as the liability issue.
Lawsuit for failure to perform due diligence in a selection. Is this for fund of funds or just generic blind funds?
For fund of funds,
Oh, yeah,
because
of course. Yeah, for sure. I mean, that's really, when you think about it, that's really what you're getting paid for, right? So the reason you're getting compensated and the reason you're not considered a broker dealer is because you're doing work on behalf of your investors. And that work, to your point, is the due diligence on selecting the particular asset class or doing your due diligence on the sponsor. So, if the underlying deal fails, look, Nico, I think if the underlying deal fails, you're going to get caught up in that no matter what, right? And I think that that's what you're getting to that point. Like, even if, obviously you're not managing the underlying fund, right? You let's say I'm the underlying fund. So Nico invests in Mauricio's fund. Even though Nico isn't day-to-day man, he's a limited partner just like everybody else. And Mauricio screws it up, and I lose all of the investors' money, including Nico's funds, their money. They're going to come after Nico because the investors lost money. They want to want their money back. And to your point, Nico, you're the one that made the decision to invest in my deal. You did the due diligence on me. You did the due diligence on the asset, and they're going to come after you. And then you're obviously going to come after the sponsors, and you'll probably have an indemnification claim. But if you have the deep pockets and Mauricio files for bankruptcy and I've lost all my investor money and there's nothing left, and you have deep pockets, they're going to become, like, I guarantee you they're going to be coming after you. And it sounds like you've already started to see that. If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.